very playable trade on a short-term basis right there. So the end of this month, I think, is going to be an opportunity, and 2 weeks before the end of December.
Okay, Peter, Mark, hang on, and also Jack, we'll be back with you. We're going to have more. Let's get back to our featured roundtable. Mark Pato, U.S. market strategist at Cantor Fitzgerald, Jack Malvi, fixed income strategist at Barclays, and Peter Schiff oversees $1 billion as president of Euro Pacific Capital. Jack, let me start with you this time. Getting back to the bond markets and treasuries, of course, we've seen a whole lot of buying. Some would say that the market there, treasuries are now overbought. I know Peter thinks that they're in a bubble. What is your view on this?
They're very rich as an asset class. I think that we've got more easing from the Fed likely on December 16th and again in early 2009. This flight to safety, capital preservation trade likely will drive medium and long end yields a bit lower than where we are today still over the course of the next several months. But if you look out a year or two, the combination of tremendous supply and hopefully economic and capital market normalization will drive these yields back up higher. I think strategically the bond asset class is really not a place for a great overweight.
Right, you wouldn't be buying into that. Peter, you agree?
Well, I agree, but I think there's a lot more risk. We've had a bull market in bonds, since 1980. It's now in the manic stage. I think when this bubble bursts, we're going to take out the lows in the bond market from the 1970s. It is going to be a bloodbath in bonds. And not only that, not only are bonds going to plunge, but the dollars in which they're denominated with are going to plunge too. So people are going to get wiped out in treasuries. They're going to lose almost all their money. Or their purchasing power.
Yeah, and obviously, bond markets being very affected by what the Treasury is doing. We've been talking about the economy and, also about the Fed. Jack was just talking about where he sees Fed rates going. Mark, I want to bring you back into this conversation because if the Fed continues to cut rates, and Jack just saying that very likely to, is that going to help restore some more confidence in the markets, or will it do nothing?
I think that in terms of the markets, it's not going to be the one thing that's going to restore confidence. There's got to be a lot more that's going to come into play, and cutting rates here is only creating a wider spread for those that are borrowing against it, borrowing at the Fed window. So the idea is to try to help bring that money in, get liquidation in there, but ultimately I agree with both Jack and Peter that we're going to see higher rates, and the 10-year probably closer to 6 or 7%. Hopefully not the disaster that Peter's calling for.
Well, the big problem is, right now the Treasury is benefiting.
But in that direction, okay, we're going in that direction.
The Treasury is benefiting because everybody is focusing on default risk, and nobody believes that the Treasury would default, and so everybody is buying Treasuries as opposed to corporates or anything else. But the real risk isn't default. The real risk is that they pay you back, but they do it with a printing press. They give you money that has no value, and that's what's going to happen.
And I don't care if the hyperinflation scenario you're talking about.
Our bonds are rated AAA. They're junk bonds. They're as AAA as the subprime mortgages were. Stay away from them.
Okay, I want to get to back to the equities because we were talking ahead of the break about where's the bottom. Mark, I want to get back to you because you're the equity strategist. Where do you see a bottom in this market?
Like I started to say, I don't think that it's a matter of price, because what's driving the market down right now is not valuation. It's not the recession. What's driving, it's not even the technicals at this point. It's actually that there's redemptions, liquidations, consolidations, margin calls, and it's causing an undue spike downward. And since we don't have a lot of visibility in these hedge funds, we don't know how much redemptions they got. You look at the moment this sell-off started, it was November 15th. That was generally considered to be the drop-dead deadline for if you want your money back by December with these hedge funds. Yeah. So, obviously that's what's been coming in. They hit the back hour of every single day as they try to get more cash in their portfolios. When that stops, then I think it'll end. Yeah. Like I said, there's two time frames I aim at. The end of this month and 2 weeks before December. That's your typical tax loss selling period.
But you don't want to peg a time, though, where you think you see a bottom.
Look, I think, this is a major bear market that began in 2000. We're 8 years into it. I think there's another 5 or 10 years minimum left in this bear market. The Dow was worth
5 or 10 years. Did I hear you correctly?
Yeah, the Dow was worth 43 ounces of gold in 2000. It just went below 10 ounces of gold today. I think it's going to hit 1 ounce of gold before it's over, just like the last major bear market. Remember, in 1966, the Dow was at 1,000. It was worth 20 ounces of gold. By 1980, the Dow was at 800, and it was worth just 1 ounce of gold. The Dow did not get back above 1,000 again until 1982. From 1966, major bear market. This one is going to be worse.
Where do you see the Dow? Okay, if you're talking about a bear market 5 to 10 years, I mean, where you see the Dow at 1,000 or what?
Well, I don't think it's going to go that low because we're going to have a lot of inflation. But in terms of the price of gold, I think we can see stocks lose another 90% of their real value in terms of gold. I don't know where the nominal value is going to be. I think it might be somewhere between 4,000 and 6,000. I don't know when it's going to hit it, you know.
Okay.
But people aren't going to make any money in the general stock market.
All right, 4,000, 6,000 Dow, almost hard to believe. And you guys are staying with us after the break still, and we'll talk about that with Mark and Jack. We'll be back with Jack Malvi, Mark Pato, and also Peter Schiff here in the studio with us, with me, to talk more about the markets and the outlook for the markets next week and also by the end of this year. Keep it here. Okay, let's get back to our featured roundtable. Mark Pato, U.S. market strategist at Cantor Fitzgerald, Jack Malvi, fixed income strategist at Barclays, and Peter Schiff, who oversees $1 billion as president of Euro Pacific Capital and also is the author of Crash Proof: How to Profit from the Coming Economic Collapse. Jack, I want to bring you back in because, not just in relation to the bond markets, but what are you going to be looking for in terms of key events over the weekend and also into next week? Are you going to be looking for some resolution to Citigroup? And will you be looking also very specifically about how retail sales play out?
Well, really nothing specific over the weekend. I mean, of course, Citigroup, but it's hard to know the timing and the denouement of what's going to take place there. And yes, over the course of the next week, I'm sure, particularly this day, next Friday, we'll all be regaling stories about how Black Friday went down, and not just in the U.S., but around the world, about the sorry saga of diminished retail sales. We'll be looking at all the policy measures and continue to reflect upon what the new Obama administration means in the U.S.
Mark, what will stick out for you? What are you going to be looking for in terms of discussions about Black Friday?
Well, the expectations have already built in a really bad holiday season already, so it's all going to be a matter of degree and how much people reel it in. Breaking $2 on a gallon of gasoline is a positive, but it's been overlooked in here. Not that it's going to save the holiday season, but it might. All it needs to do is not be up year over year, but be better than the expectations. The expectations are so grim that any little uptick is going to be a positive story, and I think we're looking for positives out there right now. But like I said, there's so much selling going into every rally that it's really hard to get bullish.
Yeah, it's a low bar set for any type of satisfaction.
Yeah.
Yes.
Well, it's going to be more like a black and blue Friday, I suppose, and it's going to get a lot worse for the retailers. But that's a good thing. As we were taking our credit cards to the malls and buying imported products and running up these trade deficits and leveraging up our houses, that was the problem. The solution, of course, is that we stop buying stuff. We need to just remember it's a thought that counts. Americans need to stay home for Christmas and not buy as many presents. We have to start saving and digging our way out of this hole. Of course, that means a lot of pain for the retailers, but that has to happen. We need to shrink our retail economy. We need to get rid of a lot of excess capacity. We have more shopping centers per capita than any place in the world. We don't need it. We need more factories. We need more people making stuff. We don't need people buying stuff.
Okay. Jack, you get the last word. Let me ask you, we mentioned Citigroup. We talked about Citigroup. Bottom line, is Citigroup too big to fail?
You put me on the spot here. The reality is the government's behind it, so they're one of the 9 banks. Yes, they're too big to fail.
Okay.
Nobody's too big to fail.
All right, we'll continue this discussion at another point, but thank you very much to you gentlemen. That is Peter Schiff of Euro Pacific, as well as Jack Malvi at Barclays and Mark Pato of Cantor Fitzgerald. Thank you very much, gentlemen, for joining me on this Friday afternoon, and have a great weekend, everybody.